And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
And good morning and welcome to the show. It's the second best day of the week, as of course it is Thursday. Get ready to wrap this week up. Big week of earnings. We had Google last night, Tesla last night. Google coming in better than expected. ServiceNow also, just disclaimer, we own both those companies. Also beat earnings handily last night, so both those stocks look to be trading up this morning following those earnings reports. Tesla reported weaker than expected sales, but the stock's not really taking too big of a hit on that right now. We'll see how that kind of plays into the markets later on this morning. But Tesla's had kind of a lot of the froth beaten out of it over the course of really the last year or so. Stock's been down pretty sharply from its previous peak. So not surprisingly, now markets kind of looking through these earnings reports, kind of hoping, kind of looking for potentially a better outcome for Tesla in the future based on other things that they're doing just outside of car sales. We're still in that heat of the moment right now for earnings, and that's going to ramp up next week even more. We've got Apple, Microsoft, Amazon all coming up next week. So lots of big earnings today as well as tomorrow and then all of next week. So as of the end of next week, earnings season will be about 80% done. We'll have about 80% of all the companies will have reported by the end of next week. So we're going to have a really good handle on kind of what earnings season looks like. And obviously already we've seen a lot of companies beating expectations. We're going to have a high beat rate, probably 75 to 80% beat rate. But that's not surprising. Again, as we talked about, we lowered estimates so much going into this quarter that that's high beat rates kind of a result of that. But as we move into next quarter, estimates are now starting to ratchet back up again. So we'll kind of see how this plays out. But economic growth is going to be critical here. Despite weaker macro data that we're seeing on a lot of different fronts, markets are looking beyond that and expecting growth. So the markets are hoping for economic growth to come from somewhere, but the macroeconomic data certainly doesn't suggest that right now. Doesn't mean that can't change. But there is a detachment right now between the markets and the overall economy. So at some point, those two will have to marry because, again, as we've talked about previously, earnings come from economic activity. So if economic activity isn't growing, then where are earnings supposed to come from, right? So that's going to be one of the issues. One of the good pieces of news, of course, everybody's kind of looking at in terms of Google was CapEx spending. That's set to increase as well. So again, when we talk about AI, and that's something Mike and I will get into this morning a bit more, on the website yesterday, Mike published his new article talking about how AI is driving the markets. We're going to talk about that. But part of this conversation is that this CapEx spending on AI by these big companies. The other side of this is that there was a very interesting article out yesterday from Goldman Sachs talking about how AI is basically just sucking up all the electricity at this point. And that's going to be more problematic because, again, we have to supply that electricity. And this is why we've written articles recently, Mike in particular, talking about behind the meter solutions, how they're going to tap directly into natural gas pipelines to get the energy that they need to power these AI data factories until we can build out electric grids, build nuclear power plants, et cetera, which are much further down the road. So, it's all very exciting stuff, right? Lots of future development coming from all this, but the big question is where's the economic growth to support all that? And hopefully AI can generate that. AI is productive investments. I've got an article coming up talking about how Morgan Stanley recently talked about how this AI is going to cause $1 trillion worth of debt, now corporate debt mostly. But kind of saying that's a bad thing, but it's not a bad thing, right? It's okay to use debt as long as it's for productive purposes that create returns. If I borrow $1 trillion to make $2 trillion and I pay back $1 trillion and I keep $1 trillion, that's not a bad thing. The problem is with government debt, as an example, we spend a lot of debt in non-productive areas such as Social Security, Medicare, welfare, et cetera, which doesn't have a long-term productive return to it. So that's the differential and the one thing. So yeah, it's okay that companies leverage up debt to build AI as long as it's productive. All right, here's what you need to know before the bell this morning. We talked about the last couple of days. Again, earnings season going on right now. Everything is fine. Earnings reports coming in better than expected. Market had a nice rally yesterday. And again, we talked about a bit yesterday that, you know, the market was kind of gyrating around, and what we wanted to see was a day where the markets actually just kind of ground higher all day, and that was yesterday. So actually a very bullish day yesterday for the markets. We had good solid buying all day long. We've had, you know, quite a few days where the market was just trying to give up gains and those type of things, but yesterday a much better outcome for markets, kind of just from a buying perspective. And, you know, the one interesting fact yesterday was that volatility index collapsed. We were trading around 16, 17 on the VIX, and we just fell very sharply yesterday to 15 on the VIX volatility index yesterday. So just kind of all of a sudden just kind of gave up on volatility concerns and hedging for risk. And there was just a lot of, we've talked about this rise in complacency as of late, and we're now getting to very, very low levels on the volatility index. And again, that doesn't mean anything in and of itself. And as we've talked about before, a lot of these things like put-call ratios, like the volatility index, like credit default swaps is another one that's basically, that's in today's daily market commentary. We talk about high yield spreads relative to treasury spreads, but credit spreads are extremely compressed as well right now. Again, nothing wrong with any of that, but what those are ingredients. And as we've talked about before, ingredients by themselves are inert, just like gasoline. As long as gasoline's in a can, it's inert, right? You can store gasoline in your garage. I wouldn't put it next to the hot water heater, but you can store gasoline in your garage. That's okay. Drop a match into the gasoline can, now you've got a problem because those ingredients need a catalyst to ignite. And again, when you have extremely compressed volatility, you have extremely high levels of complacency like we have in the markets right now. Credit spreads are very, 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 very tight right now. When you have those type of ingredients, again, nothing wrong with those. Those are supportive of a bull market in the near term, and that's what's happening, right? This lack of fear is allowing investors to speculate and make more money. And again, we saw it like yesterday as a good example. We saw one of the largest surges that we've seen in a while in short squeezes in terms of, and we saw this in a lot of companies like Kohl's and a lot of these other meme stocks. We're kind of back to that 2021 type, period where we're seeing these big short squeezes of companies that have big outstanding short positions. That speculation is okay when the market is cooperating. But again, these ingredients that you have are suggesting that we are getting to the point that any catalyst at all is going to cause a very sharp reversion in the markets as you start to unwind a lot of that speculation. It can happen very quickly. So again, this isn't a sell signal. It is just a warning that the ingredients for a correction are building, and they're building pretty rapidly. And particularly when we saw yesterday this very sharp drop in volatility just in one day, that's just something that really tells you that just complacency is really kind of coming back into the market as a whole. And again, nothing in here suggests that, but you'll note that when you have volatility spikes, that's not very good. You don't have volatility spikes without having corrections in markets. Those two do not exist in different worlds. So even a small volatility spike, if volatility goes from 15 to 20 to 25, you're going to have a 3 to 5% correction in the market. So just be aware of that the ingredients are there. Doesn't mean it's going to happen today, tomorrow, next week, week after next. That doesn't mean any of that, but it does suggest just being a little bit cautious and understanding that the ingredients for correction are there. We're just missing the catalyst. And that's the thing you've got to watch out for. All right, that's what you knew before the bell this morning. We'll come back, pick up with Michael Lebowitz, talk more about AI and the future of it. The markets don't go away. See you in a second.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Will Social Security be there for you when you're ready to retire? Richard Rosso and Jonathan Penn host our next Candid Coffee on Savvy Social Security Planning, Saturday, August 23rd. When should you apply for Social Security? And how much should you expect to receive? Register today for Savvy Social Security Planning, Saturday, August 23rd. Candid Coffee with Rosso and Penn at realinvestmentadvice.com. realinvestmentadvice.com.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
The Real Investment Show.
This is Lance Roberts with some exciting news. If you've been tuning into us every morning right here on KSEV, starting August the 4th, we'll be exclusively digital on YouTube. So make sure that you like and subscribe our channel at YouTube. It's The Real Investment Show on YouTube, also streaming live on X. Just search The Real Investment Show on YouTube and hit subscribe. Starting August the 4th, we'll be exclusively digital. Get daily market insights, interviews, financial truth, anytime, anywhere. We'll see you there.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Good morning. Good small correction, as I was saying in the opening segment. I said Tesla was trading about flat. That was last night after earnings. I checked it before I went to bed. I just checked it just as I came over here to talk with Mike for a minute. And it's down about 6% this morning. So this morning, as we kind of get pre-market, Tesla's getting a little bit under pressure. Dow implied open right now is down about 190 points as well. So, NASDAQ is going to be up about 4. That's going to kind of follow Google's earnings. Google's going to be a driver for the NASDAQ today. So, again, just, we could see this kind of tech shift this morning, particularly following earnings from ServiceNow as well as from Google yesterday. So, we'll kind of see how the day plays out. S&P futures are about flat right now. So, about 5 points on the S&P. So we'll see if the market can follow through from yesterday. But again, decent trade yesterday. Market rallied nicely. So, we'll see if we can get some more follow through on that today. So talking a little bit about AI in particular, this has been kind of the story. And, there's a lot of comparisons right now between what's going on with AI and the dot-com bubble. And if you lived in the dot-com, and what's interesting is there's a lot of people writing about the dot-com era that weren't even alive during the dot-com era, I don't think, and certainly weren't trading stocks in the dot-com era, right? Mike and I were. Mike was in the business back at that point in time. So was I. And there are some certain similarities, right? I mean, when we talk about the kind of the speculative attitude, when we talk about the excitement about AI and what potentially is going to come out of it, there's certainly a lot of similarities. And again, there's lots of charts, these analog charts running around talking about, AI and the similarity to what the market was doing in 1998, 1999. There's certainly some similarities, and I'm not going to deny that by any stretch of the imagination, but there's also a lot of differences. If you lived in that period of time, this is when day trading was just coming around. E-trade was just kind of, getting started for the most part. And it was great because now you could just trade online. You could watch the flickering lights all day of the market, red and green, and trade stocks, and it was fantastic. It was fun. It was exciting. But a lot of these companies had no earnings. And a lot of these companies were all based on just pure hope that someday this internet thing that we weren't even sure if it was a thing or if it was just a fad at the time, this whole new invention called the internet. And we were all basing a lot of promises about what that was going to happen in the future. The difference today is that AI is much like the internet. We really don't know what the future of AI is. Just like we didn't know what the real future of the internet was back in the late 90s. But the difference today is that a vast majority of these companies, the NVIDIAs, the ServiceNows, the Googles, the Microsofts, the Apples, they have earnings, and they have a lot of earnings, and they have a lot of revenue. So there are a lot of differences, both particularly fundamentally speaking, between today and 1990s. But like I said, I don't want to just wash that off into the bucket and just say, it's different this time, because things are never different this time. But there are some similarities to the sentiment and the speculation that's going on in the markets today. And we saw this yesterday with meme stocks, where we're seeing a lot of kind of a replay of 2021. There's just a lot of speculation in the market that tends to turn out badly more often than not. And the next market decline may have nothing to do with AI at all. It may have something to do with more of the more speculative action in the more fundamentally weak areas of the market. So it's at least something worth paying attention to. So having said all that, let's go to Michael Lebowitz. Good morning, Mike. How are you?
Good morning. How are you?
Good. So, you just wrote a piece on AI and it's driving the markets right now. Again, just talking about what I was just saying a second ago is, there is a lot of hype and hope for AI here. And the expectations are that this is going to, be a big driver for the economy, productivity, et cetera, in the future. So what was your takeaway in your article?
Well, so the article really just focused on trading and the markets, not necessarily the economy and the companies per se. And it kind of, when I started writing, it reminded me of the flash crash in 2010. Just sitting there that day, nothing is going on. There's no news. The Fed wasn't doing anything. There was nothing to note. All of a sudden, the market just dropped out of thin air by roughly 10%. And everyone's running around, what happened? What happened? And there was nothing to be seen. Then the market started coming back, and it had recovered most of it. But what we later learned was that there was a big mutual fund that put in an oversized sell order, and then a bunch of algorithms saw the sell order. They saw the market dropping precipitously. They must have known something was going on, so they jumped on board the trade and they started selling. Mm-hmm. And, the SEC and all the regulatory agencies investigated it. And they blamed it on algorithms gone bad. So here we are now 25 years or so later, and algorithms are apparently 70 to 80% of trading. They are the bulk of trading. Mm-hmm. And now, now what we have is AI-driven algorithms and AI driving investor decisions. And it's a big deal, right? And from so many different ways of looking at it, it's a benefit. It's a huge benefit. The amount of research we can do very quickly is crazy. The amount of creative research we can do. SimpleVisor has a great new tool that uses AI, mm-hmm. and it basically says, what would these top investors do? What would Warren Buffett do with, name a stock, with Duke Energy? And it'll go through what Warren Buffett looks for, the 5 or 6 kind of big points that he looks for in a stock, and then say, how does Duke Energy compare to that? And it'll say, well, these things he would really like, these things he wouldn't like. We'll give it a bullish or bearish score, and we'll apply this much confidence to our score. So there's tools like that can measure sentiment real time, that can go through the fundamentals of 10,000 companies and find the 3 that meet these certain thresholds. So it's really giving investors these incredible tools to find stocks, to manage portfolios, to do everything that we do, but in milliseconds, not days, weeks, months. That's the upside.
Yeah, that's the upside. But the thing that AI doesn't do is that AI doesn't go, oh, it's time to sell that stock now.
Maybe it does. I mean, I'm sure there's long, short. There's ones,
no. What I'm saying though is if I can use ChatGPT right now, right, and I can go into ChatGPT this morning, I can say, give me the top 10 stocks to buy today in the markets, and it'll give me a list. But it doesn't. But unless I go back and tell me, and say tomorrow, what are the top 10 stocks in the market today? It's not going to tell me to sell the stocks that I bought today.
Oh, correct.
Right.
Correct.
So, AI is useful to the point that you instruct it to give you information. And this is I think this is going to be one of the downfalls of trying to use AI to trade portfolios, et cetera, unless you program it real time, is that it doesn't give you feedback saying, okay, these are the positions you own. This is what you need to sell. This is what you need to buy. That hasn't evolved just yet.
No, and one of my bigger concerns is the flash crash. What happened there? One big seller came in and everyone noticed it. So you have all these AI engines that are following the market. And they, you were talking about the speculative nature of the market.
Right.
AI knows that. They see it. It sees it, not they. It sees it. And now it's recommending stocks that are following those same traits as your Kohl's and as your Krispy Kremes that are kind of worthless stocks that have doubled or tripled in the last week. So it jumps all aboard. Everyone's on board. So whereas the flash crash took 10, 20, it took like 30 minutes to happen, my concern is that a flash crash could be more engulfing and be quicker. Now, at the same time, Lance, while that sounds very scary, AI is good at spotting problems with algorithms, with arbitrages and other things. So it could also arrest a flash crash within seconds because something's not right. This stock is now 3% cheaper. There's no reason for it. I'll buy it. So there's a lot of hope, a lot of promise, a lot of challenges, a lot of risks, and I think a lot of unknowns with AI. But it's an amazing tool. Most investors are using it in some form. Some, whether they even know it or not, are using it, and it's here to stay. So we as investors have to understand it, have to understand what all those different tools are. Do they all think alike? Are they averse to selling? Do they only want to buy? How does that affect the market? And just trying to put all this together. And as time goes on, this will become second nature. But right now, this is new, and this is what we have to consider.
Well, yeah, and I think it's a good point that you bring up because, one of the potential issues of AI in terms of its set up within the financial system is that during bull market runs, it creates a massive bull market because they're just all the algorithms are all looking at what's going on in the market and feeding off that information, driving asset prices higher, but then also runs in reverse just as well. When the sell signals hit, they all start selling and they keep selling and following and start shorting that trend lower. And for the average investor, they get swept up into potentially much higher rates of volatility, bigger bull markets, bigger crashes in the future, because of the overwhelming amount of systemic trading that's going on by computers in the financial markets today. All right, come back after the break, pick up with Michael Lebowitz some more. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Will Social Security be there for you when you're ready to retire? Richard Rosso and Jonathan Penn host our next Candid Coffee on Savvy Social Security Planning, Saturday, August 23rd. When should you apply for Social Security? And how much should you expect to receive? Register today for Savvy Social Security Planning, Saturday, August 23rd. Candid Coffee with Rosso and Penn at realinvestmentadvice.com. realinvestmentadvice.com.
This is Lance Roberts with some exciting news. If you've been tuning into us every morning right here on KSEV TV starting August the 4th will be exclusively digital on YouTube. So make sure that you like and subscribe our channel at YouTube. It's The Real Investment Show on YouTube, also streaming live on X. Just search The Real Investment Show on YouTube and hit subscribe. Starting August the 4th, we'll be exclusively digital. Get daily market insights, interviews, financial truth, anytime, anywhere. We'll see you there.
The Real Investment Show.
Are you a financial advisor sneaking peeks at our stuff? Instead of trying to do it all yourself, why not just join the team at RIA Advisors? Our full-service organization can provide you with the support, unparalleled research, and tools for managing your clients' money and honoring the fiduciary pledge of putting clients' best interests first. Don't take our word for it. Talk to the advisors that work with us. Want to come win with us? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors, big enough where it matters, agile enough when it counts.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
If Lance dressed up like Danny, maybe his wife would listen to him. No, that is not the case in my household. I actually had this conversation.
She wouldn't listen to him anyway.
The Real Investment Show podcast.
I had this conversation with my wife yesterday. I told her no on something she wanted to do, and she goes, "I'm sorry, I think I misunderstood what you said."
Same show, your schedule.
You meant, yes, you could do that, right? And I was like, "Yes, honey, that's what I meant." So, yeah, she goes, "I'm going to do what I want to do." I'm like, "Okay."
All right, love you. See you.
Exactly.
At realinvestmentadvice.com.
I could wear a tuxedo, and she is not going to listen to what I have to say.
Real Investment Show podcasts are now available on iTunes. Listen anyplace, anytime at iTunes.com.
If you're working and looking to retire soon, a Medicare special enrollment period is in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors' online resources and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid gaps in coverage. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So, switching gears here a little bit, talk about the Fed. Right now, there's a lot of, debate between the Trump administration and Jerome Powell. Trump administration wants him to cut rates, and he's not cutting rates. And then there's, as of late, has been this kind of concern, some accusations made that maybe there was some mismanagement of funds relative to the remodeling of the Federal Reserve building. They're currently in the Eccles building, and they're remodeling the Reagan building to move the Federal Reserve over to that. And that cost overrun is now approaching $3 billion. Now, just to put this into context, JP Morgan just built a 60-story brand new high-rise in New York City for less than $3 billion. And they're doing a remodel on the Federal Reserve building for $3 billion. So now Congresswoman is basically looking into this matter and is potentially looking to, potentially bring, some perjury allegations against Chairman Jerome Powell for testimony he gave to Congress previously. So this is all heating up with the Fed. And one of the big questions right now is what would happen to the markets if allegations were brought and Jerome Powell was removed as Fed chair for cause. And I'm not, now let me be very clear. I have no horse in this race here at all. I'm just reporting kind of what the statements are being made. And the question is what would happen to markets if he is, I'm not saying he's going to be, I'm not making an allegation of any sort. I'm just saying if Jerome Powell would be removed for cause, what would that mean for markets potentially? Because as we were talking about earlier in the opening segment, Volatility is so compressed now. High yield credit spreads are very compressed now. We have all the ingredients for a correction, but what we're missing is that catalyst. And if Fed chair is removed for cause and the appearance, and look, whether or not the Fed is truly independent or not is up for debate. But the veil of independence, the appearance of independence by the Fed is important for the markets. And so would a forcible removal and then a replacement of somebody who would immediately cut rates and kind of go along with the administration, what the administration wants, would that undermine that at least appearance of independence and then ultimately undermine the markets? Mike, what are your thoughts here?
So I think it's a short term and long term. I think we know what'll happen if today there was a headline that said that either Powell resigns or that Trump or the DOJ has taken action of Powell to remove him from office for cause for overspending or perjury, whatever it may be. Yeah. Because when that Florida, Luna is her last name, the Florida representative, she put out a tweet, I guess it was last week, where she said basically Trump's going to fire him immediately, Powell immediately, something to that effect. Both the stock and bond market fell off pretty quickly. And then Trump hit the wires pretty quickly after, says, no, I'm not firing him. So that gave us a little quick insight into how the market would think about it short term. And, it raises a lot of questions. But then let's just go beyond that initial reaction, which could last a week, a day, part of a day, whatever it may be. We know what the replacement will be for Powell. It's going to be an extremely dovish person. So then the question is, will that new Fed chair cut rates? I mean, every day the administration is on calling for rates to be cut significantly. So will that new person cut rates significantly, or can they? They still need the votes of all the other Fed members. So there's one person saying we should cut vote. The chairman says we should cut immediately, but almost all the other ones will not be in agreement. So that raises the other potential issue is those that perceive this to be dovish, is it really dovish, at least in the shorter run? And then you have the long run issues about Fed independence. And again, we can debate all day whether they are or aren't independent. But I think it raises into question our system. And when you have assets at very speculative levels, right? I mean, it's not just these Krispy Kremes and, lack of a better word, crappy stocks that are doubling and tripling every day. Valuations are very high in the market, just in general. Like you said, credit spreads are basically at all-time tight levels. So the market is pretty wound up. And that's the risk, I think, that any action against Powell has, is that's whether it matters or not, whether Powell gets fired or not, that's what's perceived to be the thing that just basically sets markets off.
Yeah, and this is, it's interesting because the market is acting like, and again, this is, we've talked about this earlier this week, is that if you take a look at the market action right now, it's very speculative, it's very bullish. And the last time that we saw, the meme stock frenzy, so to speak, was back in 2021 when Fed interest rates were at zero, 120 billion a month in QE. And of course now, the Fed funds rate is 4.33% in the mid. And you've got quantitative tightening, everything's kind of reversed from monetary accommodation, yet markets are acting like either A, they're expecting a dramatic reversal in monetary accommodation to come and support current prices, or they just don't care about the Fed anymore. I don't care what they do. It doesn't matter. Markets are doing fine. And maybe it's the latter. But, it is interesting that, every time we have a report, whether it's CPI or employment or whatever, the entire conversation is not about whether or not there's, really inflation in the economy or what it means, or what does employment actually mean for the economy. It's what does it mean for the Fed, right? Is this going to support Fed rate cuts? And we still seem to be very tied to this idea that the Fed should be cutting rates. But what's interesting to this, Mike, is that if we go back historically and look at where interest rates are trading right now, we're about 4.3% of the Treasury. And I find it ironic that people are so, ramped up about where interest rates are in the economy. It's like, oh my gosh, 4.3% is terrible. It's about where they were 15 years ago, right? I mean, and they were low then, zero rates, 0.5% rate on the 10-year Treasury, 1% Treasury rates. Those are abnormally low interest rates, and technically not great for economic growth to have such low interest rates. But we got so used to such low levels of interest rates now that we think those are normal, and that normal rates are now abnormal. And it's just kind of ironic. But markets are wanting to go back to abnormally low rates to support speculative frenzy in the markets.
I'm going to counter that a little bit.
Go ahead.
The difference between now and if you go back to 2008, we're at the Fed funds are basically at the same exact level. The difference is the economy was growing, the trend rate of the economic growth, take out all the wiggles and just look at the trend, was decently higher than it is today. And it's been trending lower for 40 years. And we're on that same trajectory. Productivity growth continues to decline. Now, maybe AI will change that, but it continues. The growth of productivity continues to decline. Demographics are getting worse by the year. They're still okay. We're not in China or Japan's shoes, but they're not getting better. They're getting worse. So that portends a slower economy. And we have a whole lot of more unproductive debt on the books. So rates are the same, but the level of rates versus the true level of potential economic growth, right? The Fed's telling us, and if you look at productivity growth, it tells us the same thing, that the economy should be growing at 1.6, 1.8%.
Right.
That compares to 2.5% 15, 20 years ago. So just using that analysis, you could say that rates are about 1% too high. Again, I'm not arguing that rates should go, that rate should go down to 0% to ZERP and, negative rates like we saw through a lot of Europe. But rates are too high compared to all the fundamentals, unless AI is a game changer. And we're now looking at 3% growth, over the next 15 years.
Right.
So,
Which, and look, and we've written some articles about this, that, if, just for a moment, let's just, think about forward and say, okay, if we have to start spending several $1 trillion to build out AI data factories, build out, rebuild and reconstruct the entire electrical grid across the economy to support AI. And you start thinking about, okay, so great, we're now going to have, there are projections now for 2 to 4 million robots over the next 10 years. Those are all going to require electricity. So if we have to rebuild the power grid to support this additional increase in electricity consumption, which there was an article out today talking about how AI is already sucking up all the electricity now. So if we have to spend $4 trillion worth of money in, say, a public-private partnership between the government and public utilities to do this, that could increase economic growth back to 3 or 4% growth rate, something we haven't seen since the early 80s. Create jobs, create more economic prosperity, certainly bring up the level of inflation. Interest rates should trade higher at that point, but it won't matter because economic growth will be very strong and robust at that point because of what's happening in the build out of AI. The question would become, well, what will happen after that, after the big boom in the build out? And once it's all built out, then what happens to the economy, right? That'll be the question after that. But there's certainly potential there. Come back after the break. We'll finish up this conversation with Michael Lebowitz. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Will Social Security be there for you when you're ready to retire? Richard Rosso and Jonathan Penn host our next Candid Coffee on Savvy Social Security Planning, Saturday, August 23rd. When should you apply for Social Security, and how much should you expect to receive? Register today for Savvy Social Security Planning, Saturday, August 23rd. Candid Coffee with Rosso and Penn at realinvestmentadvice.com. realinvestmentadvice.com.
This is Lance Roberts with some exciting news. If you've been tuning into us every morning right here on KSEV, starting August the 4th, we'll be exclusively digital on YouTube. So make sure that you like and subscribe our channel at YouTube. It's The Real Investment Show on YouTube, also streaming live on X. Just search The Real Investment Show on YouTube and hit subscribe. Starting August the 4th, we'll be exclusively digital. Get daily market insights, interviews, financial truth, anytime, anywhere. We'll see you there.
The Real Investment Show.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors. 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. Just a reminder that as of August the 4th, that Monday, August the 4th, will be digital. We're coming off of radio, so the format of the show will change just a bit because we won't have commercial breaks to coincide with the radio station, which has commercial breaks. Also, we're now streaming live on TikTok. So if you have TikTok, you can now join the show live on TikTok. We're also on X, Facebook, as well, Meta, whatever, X, Twitter, whatever. But basically any platform you're on, we are now streaming there pretty much to that. So, find us on your favorite platform, The Real Investment Show, and certainly join us there. We certainly appreciate everyone. Be sure and like and subscribe as well. It helps the algorithms, which helps us keep helping you. So it's just a community thing, right? We just need your help, growing our channel so we can reach more people and get more information out. So Michael is a big TikToker, so
not on it.
But anyway, Mike, just talk a little bit about the Fed and independence here, and kind of wrapping up the conversation. Did you want to conclude anything on that?
Yeah, no, I actually want to counter you again. I'm being a problem for you today.
Yeah, not a problem for me. You're always wrong, so it's okay.
No. With the AI investment, the AI potential to grow the economy.
Yeah,
I'm on board 100%. I'm not denying that. The question is, so actually I saw an interesting stat earlier this week. AI, or the whole infrastructure build out around AI, is the second biggest investment we've had into our infrastructure. Do you know what the first was?
Sure, no. Railroads.
Yeah. So this already has been the second biggest ever. So the question then, Lance, is, okay, so we've already had a huge build out. There's a lot more to come, but we've already had a huge build out. So why is the economy, and if you strip out the last quarter was because of tariffs and front loading, strip out the last quarter, the economy has been growing for the prior 4 quarters at about 2.25%, 2.5%. Mm-hmm. If you go back to before COVID, it was growing closer to 3%. Why hasn't any of that infrastructure growth shown up in GDP? And I think it has. I think the real problem is that the true underlying economic growth could be close to zero. And AI, infrastructure, power grid, you name it, is keeping the economy at a somewhat okay level. So that's kind of a little counter that as the true economic growth rate continues to go lower, AI is just kind of helping stop it from going negative, potentially keeping us out of a recession.
Yeah, that's a fair statement. Because if you do look at a lot of the underlying economic metrics right now, whether it's the regional manufacturing indexes, which are basically just sitting on contractionary territory, leading economic indexes, and if you kind of dig below the surface, there is, to your point, there's certainly some evidence that the economy is actually a lot weaker. Even retail sales, I've got a comment in this weekend's newsletter talking about the retail sales report. This last one we just had, it was 0.6, and there was a lot of headlines that came out and said, "Oh, the consumer's still booming, they're still strong." If you actually look back at previous month-over-month changes in retail sales, they've basically been flatline. They're not really growing all that much, which really suggests, to your point, that the excuse me, had to sneeze, which does suggest that underneath the surface, the economy is actually a good bit weaker than what the data suggests it is.
And kind of one way to think about it, again, none of us know how this will play out and when those benefits of AI, of the productivity of AI, start really positively impacting that underlying economy. And that's ultimately what we're rooting for, is that productivity growth starts increasing again, and with it, economic growth will increase. But it's really a stimulus of form. It's not coming from the government. It's what we think and hope is a productive investment versus go back to the COVID stimulus. We had great economic growth in 21, in 22. The economy, I don't think the underlying economy was that good. What was good was that everyone had money in their pockets from the government, that corporations were getting money from the government, that student loans didn't have to pay their bills, that, we can go on and on. But the growth rate was much higher than what the growth rate would have been. And the growth rate was also being hurt still because of COVID. So you have these massive pluses and minuses that were creating just crazy numbers. But, like you said, if me and you were just out on a desert island for the last 3 years, and then we came back and we just looked at data, our traditional economic data, we would be wondering if we were in a recession, and if we've been in a recession for a couple of years.
Right.
So it's, it's interesting when you're kind of on the ground and looking at all this data and trying to put it together versus just staring at data. And that's, I think, why there are so many people calling for a recession, that have been calling for a recession. And, then you get this AI stimulus, which is probably it's certainly improving growth. And, to your point, and I think what has yet to be seen is how does it really truly impact the economy 5 years from now, 10, 20 years from now?
Well, I think that's a good point. And, this is where I think the government has an opportunity to, help create economic growth in terms of this. And again, I've talked about this, before, but, railroads are a really good example of that, is that, the government was involved in building out railroads to, move business across, and it was both public and private. Building these railroads across the country is a huge industrial boom for the economy. And AI is very much the same way, is that, just like we built the Hoover Dam and just like we built the Tennessee River Valley Authority, that were very good uses of debt to create productive returns for the economy. AI is potentially that same way. And that's what I was talking about. If the administration was really smart, they would start a public-private relationship where AI is a function of national security. It very much falls into the bracket of what the government should be doing in terms of spending money. And they do that in conjunction with utility companies and construction companies, et cetera. that, maybe it's a 50-50 split, 60-40, whatever it is. The government provides some funding, the private companies pick up the rest of the funding. And there's, because the government will generate fees and taxes on the use of the electricity that's used to provide the power to these data factories in the future. So it's a good return on investment for the government. It's great for the economy, creates jobs, creates activity, creates wages, helps the population economically speaking. And unfortunately, this may be something that passes, this administration or maybe even the next administration by, but there's an opportunity sitting right in front of them that we haven't seen really since the space race in the 60s with Kennedy, where we had this massive government public-private partnership between the government and NASA to get a man put on the moon. And that created a massive amount of technological development, created jobs, created economic growth. We have that same opportunity today if we would only harness it and take advantage of it.
Yeah, I don't know. On a similar note, if you dig into the Japan tariff agreement, they're going to be investing 500 something billion into the U.S. of new money, new capital. That will be into probably, I would assume, a lot of it into that infrastructure, the power grid, AI, et cetera. So while that's not our government investing, it is money flowing into the sector. And what I really hope is that some of these other deals that with Europe and with Canada, with Mexico, possibly China, although I don't know if we want them investing in our country, have similar financing agreements, because that's a little bit of a game changer. We now have even more capital coming into the U.S. And if we can use it productively, which so far AI appears to be a very productive use of capital, much more so than what the government typically does with their money, that could be a big win down the road. Not today, tomorrow, but down the road for this economy and for, most importantly, the prosperity of the nation.
Right. Well, no, that's the whole point is we've talked for years about the economic imbalance of wealth distribution in the economy. Of course, the top 10% of all the assets, the bottom 80% are struggling to pay bills. This could change that dynamic. This could create an environment where, the rich would get richer, certainly, but we could see increased wage growth, increased economic prosperity for the middle class in particular, who are the people that would benefit from the job growth that would occur out of these investments, whether it's construction, blue collar work. Obviously, you would need massive amounts of electricians and constructions and pipe fitters and all these type of things. That's which both Mike Rowe just recently talking about the need for electricians alone surpasses 800,000 over the course of the next few years. Is just there's this need for AI and electricity generation is going to provide trade skills with a massive amount of job opportunity in the future. And those are very good paying jobs. Those are $150,000 to $250,000 a year type jobs in a lot of cases, depending on what they're doing. So, that could really increase the economic consumption rate within the economy, create better economic growth, and create better economic stability. But again, we'll see what happens. All right, that wraps up the show for the day. We'll be back tomorrow. Jonathan Penn and Jonathan McCarty, the John Johns, talking about financial planning, financial management, more tomorrow right here on The Real Investment Show. See you then.